SoFi is back in the spotlight, and if you've been following this channel, you already know we called it at $10. Today, SoFi is trading at $22.61, more than double its one-year lows, and Wall Street is finally catching on. Analyst upgrades are pouring in, institutions are piling in, even ARK Invest just bought the dip. But what's really going on behind the headlines? Is this just another meme-fueled spike, or the beginning of a long-term fintech breakout? In this video, we'll walk you through SoFi's updated fundamentals, a technical breakdown of the chart, sentiment analysis and macro drivers, and the truth behind their latest capital raise. If you own SoFi or you're thinking about buying, you need to watch this video to the end. As a hidden bonus in this video, we also talked about one stock that is quietly gaining attention and has the potential to become the next SoFi. But first, to celebrate reaching 1,000 subscribers, we're offering a free guide that explains how top investors identify breakout stocks before the mainstream. Check the link in the description. If you find value in this video, please like, share, and subscribe so you don't miss out. And remember, this isn't financial advice. It is for educational and informational purposes only. Always conduct thorough research. Investing involves risks and some level of speculation. Thank you. Now let's dive right in. SoFi is no longer the risky pre-revenue fintech it once was. Today it's operating with a full U.S. bank charter, a massive customer base, and a growing portfolio of high-margin products. Let's look at the numbers. SoFi Technologies is showing explosive growth, with a current market cap of $24.76 billion and a stock price of $22. The company has delivered a remarkable plus 45.45% return year-to-date, an outstanding plus 205% gain over the past year, and an impressive plus 254% return over the last 3 years. These numbers highlight SoFi's strong momentum in the fintech space, signaling rising investor confidence and solidifying its position as a major player in the digital banking sector. And here's what's getting Wall Street excited. Q2 growth rate came in at 44%, beating expectations and confirming that SoFi's model is scaling faster than most had predicted. They're growing both top-line revenue and fee-based income, something analysts are finally starting to appreciate. What's more, their recent registered offering just closed, which added even more financial firepower. You might ask, why raise capital if you already have enough? Here's why that move was genius. SoFi is using this opportunistic capital raise as a strategic weapon. They plan to pay down expensive debt, lowering interest expenses and freeing up future earnings. They're now in a stronger position to pursue acquisitions if the right opportunity comes, though nothing is currently announced. Their net cash position improves, giving them flexibility and fueling long-term innovation. Even better, the move is EPS neutral. It doesn't dilute earnings thanks to the interest savings from debt reduction. This is not a distressed company raising cash to survive. This is a confident company arming itself to scale even faster. Sentiment is shifting and fast. 13 out of 17 analysts have recently updated their price targets. Some of the biggest names on Wall Street are turning bullish. Jefferies pegged his price target for SoFi at $20 to $27, Mizuho price target $20 to $26, and William Blair target $20 to $30. But here's what matters most. These upgrades are being driven by fundamentals, not hype. Analysts are waking up to SoFi's fee-based revenue engine and its rapid user growth. Even Citizens JMP is expected to update its price target after a private meeting with SoFi. Retail investors are staying strong too. Just look at SoFi's presence on Reddit, X, Twitter, and StockTwits. The community is loud, engaged, and long-term focused, and institutional interest is catching up with short interest still at 133 million shares. A squeeze isn't off the table. Oh, and let's not forget about ARK Invest. Cathie Wood's fund bought the dip during the capital raise, signaling high conviction on long-term growth. The macro setup is perfect for a company like SoFi. Digital banking is accelerating. Millennials and Gen Z are ditching traditional banks in favor of mobile-first platforms. SoFi's AI-driven lending, robo-investing, real-time payments, and member reward system hit all the right notes. They also benefit from the return of student loan repayments, which will drive more borrowers into SoFi's refinancing funnel. A lower cost of capital thanks to their national bank charter, a diversified revenue stream across lending, financial services, and tech platform segments. This isn't a one-product company, it's a next-gen financial super app. And now, with more cash, stronger balance sheets, and analyst support, SoFi is gearing up for the next phase of expansion. Let's switch to the charts. SoFi recently broke above a key resistance level around $17, a zone that had held firm for months. The breakout came with heavy volume, a textbook sign of institutional accumulation. Today, the stock trades well above both its 50-day and 200-day moving averages, a clear indicator of bullish strength. The RSI is hovering around 70, meaning it's near overbought but not in dangerous territory. Expect potential short-term consolidation, but not a reversal. The new support level sits around $22, while the next resistance zone is in the current high. A break above that zone opens the door to $25 a plus in the short term, and possibly $30 a plus if momentum continues. And long-term? The chart structure and volume profile suggest accumulation, not speculation. So what does all this mean for you? If you're a short-term trader, the chart setup is strong. Just watch the RSI and key resistance levels. If you're a long-term investor, the thesis is only getting stronger: explosive growth, cleaner balance sheet, and strong sentiment. SoFi was a speculative bet in 2021. Today, it's a high-growth fintech with the numbers to back it up. We saw it at $10. We doubled down at $14, and now with an all-time high of $25. Wall Street is finally catching up. But here's the real question for you. Are you buying now, or will you be crying later? Let me know in the comments. Figma ticker symbol FIG. The stock has officially landed. This cloud-based collaborative design platform debuted on the New York Stock Exchange with a valuation of roughly $19.3 billion following a landmark IPO that raised $1.22 billion. Notably, its shares priced at $33, well above the expected $25–$28 range, signaling already overheated investor appetite. At market open, FIG rocketed to $85 per share, up 158% from IPO pricing, and spiked as high as $109, more than plus 220% above its listing price, briefly valuing the company at over $45 billion. Figma's growth story remains one of the most compelling in the software space. In 2024, the company generated approximately $749 million in revenue, marking a 48% year-over-year increase. That momentum has continued into 2025, with Q1 revenue growing 46% year-over-year to around $228 million. Figma's gross margin stands at an impressive 91%, while its operating margin is a healthy 17%, reflecting strong underlying business efficiency. Despite a net loss of $3.74 per share in 2024, a common trait among high-growth tech firms aggressively investing in innovation, Figma is clearly positioning itself for long-term dominance. The platform now boasts 13 million monthly active users and over 11,100 enterprise customers paying more than $10,000 in annual recurring revenue. CEO Dylan Field has been vocal about Figma's generative AI push, aligning with broader investor sentiment that increasingly values AI-native SaaS models. With major venture capital support and adoption from iconic brands like Netflix and Airbnb, Figma isn't just another tech IPO, it's a bold bet on the future of design, collaboration, and AI-powered productivity. The narrative around Figma is powerful and shifting rapidly. Recent tech IPOs like Circle, plus 168% day one, and CoreWeave, plus 160% since debut, have primed market sentiment for quick returns. Despite Fig opening near $85, many more upward revisions are expected. Regulatory clearance for the previously shelved Adobe acquisition, canceled due to European competition concerns, gives Fig fresh autonomy and opens the door to new strategic moves. Fig's rapid growth in enterprise adoption, especially in AI-powered workflows, aligns with broader migration toward collaborative, cloud-first design ecosystems. Fig is not another utility SaaS stock. It's an AI-forward collaboration platform with enterprise traction and nearly unheard-of IPO momentum. The upside potential is real, but so is the risk. Valuations at debut already priced in extreme optimism. Loss-making isn't a flaw here. It's expected, but the trajectory toward profitability and market dominance is what matters. If you're a growth-focused investor willing to tolerate short-term volatility for long-term reward, Fig's valuation may still make sense, particularly if it scales, releases ambitious AI features, or expands its enterprise footprint significantly. If you're a short-term trader, opportunities may lie in tactical pullbacks or momentum plays, but only with strict risk management given the stock's early volatility. In all cases, Figma's IPO debut is not just a headline, it's one of 2025's clearest signals that premium AI scaling platforms are in high demand. For those paying attention, Fig could be far more than a short-term pop, It could mark the start of a defining fintech software franchise in the making. The question is, are you buying Figma now, or would you wait for a pullback? Let us know in the comment section. If you find value in this video, please like, share, and subscribe so you don't miss out. And remember, this isn't financial advice. It is for educational and informational purposes only.